The big deal with short-term rentals is most Americans are W-2 income earners, and they are not full-time into real estate in some shape or form, right? That would be something like, and we can discuss this too if you want real estate professional status, but because most people are working a full-time W-2 or both spouses are working a full-time W-2 or they've got their other business, it's just really hard for people to meet the actual real estate professional status. And again, we can get into that in a second. But the beauty of the short-term rental and why this is so common and probably the most common kind of tax strategy for our clients and W-2 earners in general is because the time requirement is so much less. And so basically, if I can just take a second to explain the short-term rental strategy, I think that's where we're headed. Really, in general, it's essentially two different steps or two different requirements. And step number one is basically you have a property that has an average stay per guest of 7 days exactly or less. So that's very typical. Vacation rentals, you've got a property in Miami, wherever it is, right? And you have on typical, just weekend stays. That's very typical for Airbnbs in these vacation rentals. Okay. So great. We've met the first step. Great. On average, I've got a couple rentals during the year and I met that. Now, step two is the part why most people move into this, in my opinion. Step two is then material participation. And as you evaluate the material participation test that we have from the IRS, there's really 7. And if you're a W-2 income earner trying to say, what is the lowest requirement that I need to achieve in order to successfully meet kind of this short-term rental tax strategy or loophole, not everyone loves that word. Basically, what we talk about most is the 100-hour rule, okay? Because the contrast to that, the kind of second most common in my opinion, is the 500-hour rule, but that's a lot of time, right? If you've got a full-time W-2 job, over the course of, say, you work 50 hours a week, that's 10 hours a week you have to put into your short-term rental over the course of the year. However, with 100 hours and more than anyone else, that's a huge caveat to the uniqueness of this specific test that we have from the IRS. 100 hours and more than anyone else, typically you can achieve something like 100, 150, 200, which is hundreds of hours less, right, than the 500-hour test. Now, again, the big caveat there is you have to have more time than anyone else. So you will probably see from us, you will probably see online, and we can discuss here if you want, that having someone like a property manager is going to make that difficult because now you have to compare your time, right? 100 hours and more than anyone else. So 100 hours is like a minimum threshold. You have to get more than anyone else. So property manager, cleaners, handyman, contractors, whoever it is. Okay. So if you start to hire out all these things to other people, number one, you are getting less time. So that's making it harder for you to get to 100 hours over the course of the year. But number two, you also are now competing with more people who are now accumulating more hours, right? So the more that in, especially the year that you want to meet the short-term rental loophole, and I'll explain kind of what in benefit this is in just a second, Kirby, and for listeners, but basically if you can get this test and you can manage it yourself and do as much as possible in the first year, number one, you're going to more easily get the hours, but number two, you have less to compete against, okay? So there's a lot of strategy there, and we can always discuss that too, Kirby, but ultimately people are like, okay, well, what's the benefit of meeting this? That's kind of a common issue and question I get. Why do I want to meet this? Because that $35,000 that Kirby and I just went through in our example, that tax savings is zero if you do not meet the short-term rental strategy and do a cost seg, okay, if you do this wrong. That is $35,000. That's an actual reality that could be in your bank account if you have a short-term rental, you meet the short-term rental strategy, you have a cost segregation study done, you do all the requirements correctly on your tax return. All these things have to come together. If we mess up on one of these, we don't meet the short-term rental strategy, you don't meet the time requirements, you don't have a time log, all those things, then that tax savings is poof, gone. And there's the way I tell people is there's about 10 ways to do this right, and there's 80, 90 ways to do this wrong. And so what we want to do at our firm when people work with us is help people stay on the straight and narrow path to get this done right. Because if you start to veer off into any of these directions of personally using it, you don't get a cost seg, you put it incorrectly on your tax return, all these things, then it's all for nothing. Like you do it incorrectly or it's illegitimate and you get audited and you lose it and you have this interest and penalties and all these things. And it just blows up. So we want to be proactive in that, say, hey, here's exactly what you need to do in order to get this right. So you got to meet the short-term rental loophole in order to get these losses to offset things like your W-2 income. Okay. So if you're making $500,000, $400,000, $300,000 a year, and like we went through in our example, you were accelerating a $100,000 loss, like Kirby was saying a few minutes ago. Now we're paying, instead of $500,000, $400,000. And that's where the tax savings come in at $35,000 in a tax refund, potentially. So
Yeah.
I know I just had a huge monologue. I always get very excited and animated about this stuff, but what questions should I
No,
should I wrap into there?
it's a great explanation. And one thing
Great.
I think a lot of people would be curious about is that 100 hours. What qualifies for that 100 hours?
Yeah. So it really falls into kind of three main buckets. You could say really two if you're going to play it safe, just for kind of this general comments here. Number one is going to be essentially management time. So that's kind of why you'll hear online or kind of from us, like, be careful hiring a property manager, because you're going to get a lot of time there, especially in the first year. So that's going to include things like, speaking with guests. That's going to include things like managing or doing the cleanings. Actually, that's more of the second thing. Setting up the listing, right? So kind of the advertising, getting it up there on Airbnb, VRBO, things like that. That's going to include things like, getting the pricing right. That's going to include, talking to guests, doing all that kind of communication, and making sure things are set up appropriately. Okay, so the advertising, the management, all that kind of stuff on just a regular basis as guests are there. But then another kind of second key kind of bucket that I put people into is really the physical work. And so that's like the getting things set up, as in like you put in the furnishings, you go and buy the, decor, you go and buy all the things there. And maybe you've got some things that need to get fixed or some improvements, or you're going to add more amenities, kind of the physical work. So you've got basically bucket one is kind of the management, the taking care of it, talking to guests, getting things set up, the advertising. And then really kind of bucket two, to keep it simple, is really the physical work, the cleaning, the repairs, the improvements, the setting it up, the furnishings, all of that kind of stuff. Those are kind of the main two. Sometimes, depending on their situation and if they have management, we could include other things like, buying the property, the financing, getting that going and things like that. But there are certain things that you want to be careful around, especially if you've got a property manager, like, travel time or quote unquote education hours, where, hey, I read a book on the short-term rental, or went to this conference. Is that material? No, it's not material participation in general, and things like that. So it's really got to be like true work that adds value and is necessary for the operations of this property, right? So absolutely management and absolutely the kind of physical work that needs to get done. So does that help? That answers some of that?
Absolutely. Yeah. And my wife and I work on this together. And I think a lot of spouses do. We file jointly our taxes. So is this 100 hours individually or 100 hours collectively between the two of us?
Yeah. Great question. So if you're married and filing joint, it is then both of you combined. If it is something where you're married filing separate or single, then it is kind of looked at individually. But that is one of the beauties actually of basically being married, is you guys are seen as one taxpayer instead of two. So if we're married filing joint, now the time requirements, it is kind of combined, which is beautiful. And it even kind of taking that further, if you've got multiple short-term rentals and you've got, say, 2, 3, 4 properties that all meet the average stay less than 7, you can actually group them together to help you meet now material participation as well. So it's not just combining you and your wife if you're married. Now it's combining the number of properties that you have too. So this can be something that kind of, as you grow and scale, can theoretically in some ways get quote unquote easier in order to meet the time requirements. It can be difficult the very first year, depending on how passive or kind of involved you're going to be. But absolutely, just to answer your question, it's the two of you if you're married filing joint, correct?
That's great, because I hate the setup process. That's a part of the process I despise. We just finished a 5-unit, and I think my wife could qualify for 100 hours just setting up that 5-unit alone. And I opted out of that process. So that's good to hear that it's a combined total. I'm curious, do you think it's too late for somebody who wants to take advantage of this in 2025? Do you need to start earlier, or what do you typically see for that with your clients?
Yeah, another super common question I'm really getting this time of year is kind of the same thing here. The short answer is no. It's not too late. And don't feel bad if like this is completely new to you. Then it's like, well, you didn't know about this before. The only people that I give a little bit of shaming to is people who have known about this for like a year, and it's like, why didn't we get started like 6 months ago, 7, 8 months ago? If you knew about this, why are we procrastinating this? Because now, like, you're even thinking right now, just logically, you've got less time to do this. You've got less time to find a property, identify, market, all those things. Like what were we waiting for? Maybe there was a financial reason, or you had to, store up cash, and those are all legitimate reasons. But just for those of you procrastinating, it's like, yeah, you had a better chance of doing this and getting this implemented for this tax year had we kind of started, or you had started kind of looking at this sooner. But yeah, it's totally still possible to do. I have, just as an example, Kirby, I had a client who I think he closed on it like right around Thanksgiving, November, and this was 2 years ago, and got it up and running kind of very shortly after that. I think within a week or two, and he met the short-term rental loophole tax requirement. So it's not impossible. If you're just starting to look and you're just starting to put together capital, that can be tough if you're kind of starting from square one. But if you've got the capital, you've got some of the financing, you've identified your market, all those things, and you're kind of already looking and identifying properties and putting in offers, it's definitely not too late. Just depends on then how quickly you can turn over the property to get the furnishings in, how quickly do you need to do any improvements. If it's a fixer-upper and it's going to take months to do all this, obviously it's going to be more unrealistic. But if you've got a good, decent property and it's mostly up and running and ready to go, totally realistic to do that. Absolutely.
Got it. That makes sense. And how do you determine if what price point it makes sense to do a cost seg study? Is there a certain threshold that you're like, under a certain amount of, it's just not worth the cost of a cost seg?
We look at kind of two things. One is absolutely the price, so the purchase price. But number two is also like the tax bracket that the individual is in. So if you're in the 30s, that 32, 35, 37, I mean, you honestly could go as low as like, we'd say like 150, 200, especially with 100% bonus depreciation being back. But part of that as well is, what is your kind of expectation? Is this something that you can only do this year? Are you going to add in a bunch of improvements next year or something like that? Are you going to not meet the short-term rental loophole requirements this year, but you can meet it next year? So the timing specifically of the cost seg is going to be important there, of what's really going to go on with the client. But yeah, I'd say, just to answer your question specifically, probably that 150, 200. But then the other component of that too is, what type of study are you going to get done? There's really, I break it down mentally into kind of two different buckets. One is you have something that's more of a do-it-yourself. Oftentimes they call this like a software study. Those are much cheaper, right? Because you're just kind of doing it yourself. You're paying for this software, and boom, 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 you plug in a bunch of numbers, and it spits out the report. You don't have to get any sort of engineer involved. And then there's option two, which is the more, like I was just kind of alluding to, an engineered study, which is, hey, you have a professional engineer do these, and those are going to be just a lot more expensive. Right, kind of the more do-it-yourself software options, those are usually going to be around $750, so several $100s. But the engineered studies, because someone's going to have to really take the time, manually do it, blah blah blah, and whatever, those are usually going to be like no less than like $3,000, $2,500, and could be thousands of dollars more, depending on who you use, size of the property, all that kind of stuff. Right, purchase price, where it is, all of that. So depending on, like, for example, let's take two extreme examples. If you've got someone who's like, hey, 32% tax bracket, and they are going to have a $200,000 property, I would probably typically push them towards a software study. However, if we've got $1 million property and we've got someone in the 37% bracket, I'm usually pushing them towards the engineer. Right? You've got a higher tax bracket, higher purchase, and just the additional few thousand is likely going to yield more tax savings than the additional incremental cost going to the more expensive price and more expensive cost segregation study. So that's kind of like some of the delineation that we think here. It just depends on kind of what's really going on.
Yeah, that makes a lot of sense. And for people listening too, I'll put a link to a little bit of a hybrid between do-it-yourself and an engineered study that I've found to be the most cost-effective company out there. I'm using them to do a cost seg this year for one of our properties. So I'll put that link in the show notes too, if you guys, if someone's looking for someone to do a study for them. I mean, bonus depreciation, I know we talk about it typically in terms of, the short-term rental loophole and real estate, but this can be applied to other business equipment and even vehicles, right, to help offset taxes?
Correct. Yep. And really, yeah, bonus depreciation or Section 179, those are obviously two common ones. And the reason that, especially, so like, let's say you do have like an equipment business or something like that, where you own equipment and then, lease it out or something like that. Yeah, that's not something that you typically need a cost segregation study for, right? Because the whole piece of equipment is eligible for the Section 179 or bonus depreciation 100%. But the unique thing about real estate specifically is that not by default do you get those numbers. Right? You have to get a study done by a professional, according to the IRS, to get those kind of specifics around your purchase price, breaking down the components into that 39, 5, and 15-year property. So that's kind of the unique thing with real estate is there's so many components just within your purchase that you don't get by default. It's not on the closing statement. It's not like, hey, the IRS sends you some, depreciation schedule. You've got to pay a professional to get that done. But vehicles, equipment, all of that stuff, you buy a vehicle for over that 6,000 pounds, gross vehicle weight rating. Yeah, by default, that's eligible for, if you use it for 100% business, obviously, you can get that full deduction immediately. You don't need a cost segregation study to get that number. It's just the purchase times your percentage you use it for business, and that's your deduction. So there's no special study. It's just real estate that needs that extra study. But yeah, absolutely, totally applies to other businesses, vehicles, equipment, absolutely.